Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently roughly 4:15 p.m. Eastern, winding down the end of the North American trading session, Wednesday, May 15th. Today was the all-important, all-elusive CPI day. We were preparing for the CPI report since the very start of the week where I did the educational webinar. And the reason why we did that webinar is because this CPI specifically was in very heavy focus. But we had this tug of war between scenarios. Would we just follow the logical data and still show higher than expected inflation as majority of asset classes, commodities, costs of goods are at higher prices? Or will the Bureau of Labor Statistics, working hand in hand with the government and institutions, look to manipulate how the data is presented to the public to still keep rate cut bets active and avoid spooking the markets and spooking the public before elections, which are just around the corner when looking at the US timeline, right? Because of this, we understood that we have to be very, very adaptive to the result. And that is why we had all of these various scenarios created. And I even went more in depth of what exactly to expect with the CPI year over year result here. Okay. So today with US CPI year over year, it came out right on forecast, dropping down to 3.4%, which was exactly what the market was expecting. Hence, the forecast was 3.4%. But because this is feeding into stock market greed, still supporting political and corporate interests, and still obviously keeping rate cut bets active, it's still going to hold a bit more weight. So if we did have CPI result at 3.4%, we were expecting to see some US dollar bears, gold bulls, and US30 bulls, expecting a medium market impact with inflation right on forecast, more lower time frame price whipsaws, and less overall movement, estimation between currencies, metals, and equities, 50 to 200 pips. This was a pretty good estimation. We got a little bit of a boost on this because also the same time at 8:30 a.m. Eastern, just to add a little bit of fuel to the rate cut bets fire, we also had a New York Fed manufacturing report drop even lower in the negatives. And we had retail sales monthly drop below forecast and below prior to 0% flat. Having weaker consumer activity data and weaker manufacturing reports highlighting potential recession scares also feeds into rate cut bets, but having weaker US economic data is also a catalyst in itself to lead to less demand in the dollar and more demand on gold. Gold gets that boost for its safe haven appeal to hedge against risks, and you see that appeal increase when you have bad economic data. But gold is also bullish in a lower interest rate expected environment. So rate cut bets also keep gold bullish. Weaker US economic data is bad for the US dollar, shows weakness in the US economy, less intraday demand in the US dollar. But that weaker data also increases rate cut bets, which rate cut bets is also bearish for the dollar too, right? So we got a little bit more than 200 pips, getting around 250 to 300 pip total moves after the price whipsaws we expected, right? The central bank policy cues are that it still keeps rate cut talks on the table and market greed alive, but may not bring full confidence for Feds to cut rates yet. It still allows the Feds to take a slow and steady data-dependent approach. The main takeaway is that rate cut euphoria, stock market greed, is still kept alive. And that is the narrative still holding the most weight. So we do have to adapt on some asset classes. Gold, we did a great job today with the updates where even from the previous market update webinar, from 2350s up, we were looking to at least retest into the 2377s and wouldn't even think about sells unless we hit into the 2377s. We did get this rejection here from 2377, but we weren't looking for sells during this time period. This time period here, overall, was the prime portion of the New York trading session when we had New York open dip down a little bit and then had the CPI data come out, retail sales data come out, and the Fed manufacturing report come out. All of this data supporting some more gold bulls, but CPI being on forecast can still lead to those price whipsaws and liquidity grabs. So because of the economic data result, I sent updates right away, right at 8:31 a.m. Eastern. It may even be right at 8:30 a.m. Eastern in the same minute the data gets released. I really try to make sure I'm quick with it, that rate cut bets are still active. After we see liquidity grabs and price whipsaws, we are going to be playing dollar bears, which means GU, Euro USD bulls, UCAD bears. And we're going to be playing gold bulls, gold buys, and stock market bulls, stock market buys. With the initial CPI volatility, we called a nice scalp from 2367, which was just bouncing in between the levels here. But the main meat and potatoes trade, like we talk about in the educational webinars, is really when the noise and dust settles after you have the initial whipsaws. We were eyeing the price to retest where we saw some orders accumulated yesterday in this general area of retesting back into this order block, even potentially coming into retest bullish structure here. The first call out was during the initial volatility for some quick scalps, quick jabs, and observing price action to see if we can hold it longer. Going into that new 4-hour candle, 9 a.m. Eastern in NYSE, we assessed that with the failures to hold above 65, we could easily get deeper pullbacks. The second area to look for buy bounces was 2350 to 2355. We peaked out here in the middle of the key levels, roughly around 2352, but started to show more lower time frame price stabilization at 2355, then having the continuations above 2357. What we want to note here is thanks to the rate cut greed from lower CPI right on forecast, recessionary scare data from weaker retail sales, and the decline in the Fed manufacturing report, we did a good job adapting to the buys. But what's good to note is we also had new intraday highs printed. The fact that after this accumulation and the buys that we adapted to above 2350 and the ones that we called through the live New York session, market trade room updates and banter updates, it led to these new highs being printed, still shows buyers in full control. I don't really see any reason for a deeper pullback leg like this. In my opinion, we might just get a slight retest to the previous highs with the current rate cut euphoria holding the most weight and continue the squeeze another 200 to 300 plus pips into the last all-time highs at least before we even think about looking for any type of sell positioning. In terms of the candle bodies, that's digging into the 2400s. In terms of the wicks, we're looking at into the 2420s. Right now, into this new daily candle, once this one closes in just about 33 minutes here, what I'm really looking at is just some continuations through Asian after a minor pullback. I think we might not get a deeper bearish pullback leg until we see potential more buyer profit-taking moves into these highs. Asian session continuing just some of the lower time frame momentum and price action may just give us a nice retest of the previous highs, lower time frame structure rather than intraday bullish structure or daily bullish structure. Intraday LTF structure. When you have fundamental catalysts in play, one-sided momentum, the volume and liquidity still healthy, you don't really want to fight that momentum and start to sell it. But also, more importantly, you don't want to expect a larger corrective phase starting to take place for no reason. In my opinion, through the Asian session hours, even London session hours, if we're still respecting above this previous intraday high here, roughly in the 2377s to 2380s, also still maintaining the lower time frame bullish structure that has held weight from yesterday onward, then we're not going to see a deeper pullback leg yet. We could still be seeing that squeeze with rate cut bet euphoria active. No major events in terms of pre-planned data for the rest of the week on the US side. Nothing as important as this inflation report we had. And with some of the economic data being in recessionary scare ranges, looking at retail sales dropping back to 0%, much lower than expected on the forecast, and manufacturing data digging deeper into negative integer territory, we could still see this squeeze up, in my opinion, to the 2400s minimum. If we get this pullback to the 2380s, 2377s, that's still like a 300 pip run. Even if we get a minor lower time frame accumulation through Asian and breakout higher, that's still like another 150, 100 plus pip run. We might not see another bearish corrective leg on the intraday time frames in my opinion, until we're peaking closer into these all-time high prices. Maybe see a profit-taking move at the end of the week, right? But overall right now, we have no reason for any long-term gold bears because of rate cut euphoria still being active, recessionary scare data still being active. Now we've had that surprisingly poor jobless claims and jobs reports data, lower than expected inflation feeding rate cut bets, weaker retail sales and manufacturing data feeding rate cut bets and just recessionary scare data. Tomorrow we got jobless claims again, if I'm not mistaken. We'll double check the schedule in a second here anyways. But if that's weak a second time, we're still going to see gold extending into these high prices. And we may not see any bearish pullback until like the end of the week or even into next week. And we were looking to see if we're going to start to get any signs of exhaustion. We were looking to see if we're going to get any signs of exhaustion back at these last all-time highs. Not some major reversal, but just buyers taking profit again in pullback waves. For example, like you can see here, when this candle body high was printed, even though you had this extended bearish pullback phase, oops, should be red, like this situation. Holy shit, my Epic Pen's going crazy. Okay. Even though you had this extended bearish pullback phase short term that lasted a couple of weeks here, right? Very similar to like what we saw take place here, where we are breaking out of that corrective bearish structure and showing more buyer demand in play, right? Just in terms of normal transactions in the market, buyers and sellers exchanging hands in a bullish trend, buyers liquidating at new high positions or previous high positions. Sometimes you don't always instantly break out into new highs and just continue the trend. For example, here, you can see you had a fantastic bullish move from 2000s all the way back to the highs at that time, which was the 2080s, 2090s, right? For that couple of weeks there, beautiful bullish moves, pretty solid bullish structure, higher highs being printed, stronger bullish candles. Even though you had that stronger bullish move, at these previous highs, you can see the price action confirms of failing to break higher and starting to show some signs of exhaustion. This doesn't mean that you're going to expect to see some gold reversal or gold meltdown for no reason. It just means understanding these transactions between buyers and sellers, which to us can be translated through price action reactions at previous key highs or lows, starting to measure how much weight economic data or fundamental events are holding. Yes, we could still dig into here. And I'm still very bullish on gold here due to the reasons stated of adapting to the lower CPI, weaker recessionary scare data, even from the prediction last week where we called the surprisingly poor jobless claims. Gold's still bullish on the higher time frame. What we just have to be careful of is when these corrective bearish waves take place, right? So maybe with this CPI data being on forecast, having the weaker recessionary retail scale sales data and manufacturing report through Asian and London, we could probably still see the squeeze into the 2400s here. But in my opinion, if we want to just break out higher, tomorrow we're going to need to see another bad jobless claims report showing more recessionary scare data, continued cooling in the labor market, more feeding into rate cut bets. And that's a catalyst to see more buyer demand to break out into these highs. Does that make sense to everybody? So gold is very bullish, but just from a reactionary standpoint, when you're zooming out, you always want to be very focused and watching the reactions at key previous significant highs or lows. And this is whether gold is bullish or bearish. Just as an educational example, let me show you guys. For example here, this is gold when it was extremely bearish through the 2022 most aggressive rate hike cycle by the Feds. Overall, very strong bearish run. But in this example of bearish structure, as you can retest previous lows, that doesn't guarantee that you're going to continue to break lower right away. For example, here you had this low printed pullback phase, retested the low again, and you can see then for an extended period of weeks, amidst gold's broad bearish structure, you would have buyers in control for that period of weeks there, almost half a month there, right? Same thing here after this low was printed, minor pullback phase, you retest the low, you still had a bounce of more than almost 300 to 400 pips here, and you still didn't actually end up extending the trend until almost a week and a half, 2 weeks later. Same idea here, new low printed, retest that low. You still get this bounce here. That's more than 250 to 300 pips and still lasted a week and a half before you finally had the seller pressure to break out lower and continue, right? So whether gold is in bearish macro structure or right now, as gold is in bullish macro structure, you always have to be careful at reactions on previous significant highs or lows. In this example, in more bullish structure, we want to be careful of the reactions at previous significant highs. And in this example, last all-time highs, right? Now, don't get me wrong. We have continued weaker US economic data, technical bullish price action still holding. Gold could break out into new all-time highs if we're still feeding into the rate cut bets. Still seeing that euphoria active and greed active in the stock market into the election period, right? But just from a pricing perspective, do have to be mindful where even if you don't get like some major bearish rejection or sell-off, even if you don't see some move like this, it doesn't matter. In this reaction point, even if you start to see moves like this, from a day trading perspective, as you're creating bullish structure and having the price waves created there, this potential bearish wave that could still be hundreds of pips, it's going to matter to you as a day trader or scalper. Does that make sense to everybody? Even though it's very easy to see gold is bullish, even though it's very easy to say, oh, just ride the trend and jump in gold buys, from our perception as manual retail traders, one of the most important things is timing. And one of the worst things is gold being bullish. You just think we're going to keep riding to the highs. You enter a buy up here. Most of us are not going to be having 300 pip stop losses or holding 300 pips of drawdown for 2 weeks to get back into break even. Does that make sense to everybody? Everybody following along? So what does that mean? It means that if we can use our knowledge, experience, alongside the tools we have as manual retail traders, if we can start to anticipate a pullback wave taking place, then we want to adapt to that wave accordingly. In this example here, this potential scenario, if we do peak into the 2400s, are getting multiple signs of exhaustion and a resistance being created, lower time frame failures to consistently break higher, shift out of the lower time frame structure we're talking about, then we could still see through the Asian session, even the next daily period, digging into the 2400s. But if we see this price action take place like in the yellow scenario, breaking this minor lower time frame structure, then getting a deeper pullback leg, which could even be into next week price setups, back to the 2360s, before jumping into buys again, wouldn't be out of the ordinary. And that's very important because that pullback leg to the 2360s from the 2400s is 400 pips. It's $40 an ounce a move on gold there. It might not look like much when you're just looking at the chart right now in hindsight, but it's very important to learn this information because it matters more than anything when you're live trading and executing. Because sometimes when this pullback phase is taking place, you're so zoomed into the lower time frame, you're so zoomed into your trading execution that gold will be doing a 500 pip pullback, but every 20 pips you see a lower time frame support, you try to buy. Who's been there before? I've been there before. You get lost in the lower time frame noise. You get lost in just trying to play the same bias. You just want to play the higher time frame trend. You're not paying attention to the intraday time frames or the market waves. You start to, you don't even know a bigger pullback wave is taking place. This entire pullback, every 10, 20 pips, 30 pips, you're trying to buy it. Wasting money, wasting time, wasting energy. And then you zoom out and you're like, wow, how stupid of me not to notice we were seeing a minor normal market correction. Right? This is why, who was here during the CPI, just during CPI today, who was active in banter in the trade room? Do you remember I said something very important with NYSE? I said, hey, everybody, if we're going to start to break below 2365, like when we were watching the liquidity grabs, and it's NYSE, stop looking at the 1 minute time frame. You're going to, every little 1 minute drop, you're going to try to get to a little dip buy. Why do I know that? Because I've made that mistake many, many times before. It's high volatility news. You just want to take a trade and ride and try to get some good pips. You completely forget about being logical. And all you're doing is just zoomed into the 1 minute, zoomed into the 5 minute time frame. And you're just looking at like, oh, maybe we're just going to retest this little support quick. Maybe we're just going to retest this 5 minute little area quick. And when you're having this volatility, gold and other major asset classes, they melt through lower time frame zones like a hot knife through butter, and they go straight to intraday zones. Have you guys noticed that now? So who remembers that the first thing I said was, hey, everybody, we were looking at the lower time frame for some quick scalps with the initial release, but we're not breaking higher right now. We have NYSE coming up. We can get deeper liquidity grabs. I'm noticing a lot of you still just looking at the lower time frame charts. Zoom out and start checking 30-minute and 1 hour areas of interest we could retest. And then I called out my areas of interest, which was 2055 to 2355 to 2350. We got the 2355 pullback and continuation buys through the rest of the day here, right? So when these pullback waves are taking place and you're noticing some signs of exhaustion, it's the same thing when you're bullish. Pullbacks are going to happen. You're not just going to keep moving straight up. It's going to be a waste, right? But when you can potentially anticipate those waves and zoom out, it can save you a lot of losses, save you a lot of headache, save you a lot of revenge trading. Because I've been there plenty of times, and I'm probably going to go into that situation again. We're all human. We all make emotional mistakes. Sometimes we all get lost in the noise of just being trapped in our own thoughts and our own and what we want out of the market. It's going to happen. But if we have this support system, this community of like-minded individuals, if we go through this work, what we can do is minimize the amount of times it happens. So overall, long term, we could still try our best to pull money out of the market more than giving money back to the market. But this is a skill set that takes years to develop, right? Anyways, though, talking about gold here, just something to look out for. As per Asian session, London session, give or take minor pullbacks if we're still holding above that first price sensitivity area I'm talking about. Where this is more of the macro intraday structure from the Asian session and through the CPI period, we had this lower time frame structure as well. I don't think we're going to come retest intraday structure yet for no reason. We're not showing any signs of exhaustion yet. What's an example of signs of exhaustion? Failing to break higher, starting to see some bearish engulfing candles, shift of lower time frame price action. If you patiently wait and you're not trying to grab some hero entry, you see the confirms. For example, here, when we're highlighting lower time frame structure, if you go to the 1 minute time frame, you can see failure to break higher, candle bodies closing same level, bearish engulfing candles. You'll see even more confirms because on the hourly time frame and 30-minute, we're on the 4-hour now just for reference. And you get a pullback wave. Here, lower time frame structure was holding, but at the same resistance point, still didn't show any life to be breaking out higher yet, right? Here, lower time frame structures holding. You showed signs of failing to break higher. You really got the confirms here that you're going to see a pullback wave, right? Here on gold, we're still maintaining this lower time frame structure and can potentially extend it into like the 2400s, like I'm saying. We don't have any confirms of what's highlighted in blue here. Maybe that may take place and see some normal profit-taking moves as we dig into the 2400s. But even then, if we really want to highlight that deeper pullback phase, you know the sequence of events you will be seeing: rejection, flip of structure, lower time frame, rejection, flip of structure, lower time frame, rejection, flip of structure, lower time frame, rejections, flip of structure, lower time frame. You know the sequence of events or an idea of it that will give you more indication. We may see a short-term accumulation phase, pullback phase, and overall secondary phase of market structure. Whether you want to trade those phases or patiently just understand they're taking place and wait for them to bottom out and jump back in with the trend, that's up to your discretion. It's up to your trading style. It's up to what you're comfortable with. Some people just psychologically are more comfortable selling an asset class than buying it. Some people vice versa. And they don't have an answer why. Right? So you do have to adapt everything we're talking about, take the bits and pieces and apply what works for you and use that. But if something doesn't work for you, don't try to force it. Everybody's different, right? GJ still bullish here, just showing some signs of exhaustion from the update webinar yesterday, where we anticipated digging into this 197s, 197.2 area, which was the last currency intervention price. We could see some slowdown. The buy analysis has ran great. We called the buys from down here to correct the currency intervention move. We did correct the currency intervention move. But this is where we're starting to show our first signs of slowdown of buyer price action. Right now, dollar's still weak, so there's still more demand in risk assets. So I do still see GJ holding more bullish if we're holding above the 196s and can still be creeping back into these same highs, but still being mindful into this accumulation area and the last intervention price. Dollar pairs. Obviously, we were playing dollar bears, dollar bulls from the previous weeks into the month of May, as we were still showing dollar holding more bullish structure, and we were still respecting this bearish market structure, and then just really starting to consolidate. We understood that today was the make or break catalyst. If we're seeing that CPI is still feeding into rate cut bets and the Feds can kick the can down the road a little bit, and we can still see the stock market greed active into the US elections, as these politicians and these corporations do not want to spook the markets and public before the elections. If we had that lower inflation report, we would be seeing a shift of structure here. Now it looks like on GU, if we don't have any reactive events like geopolitical tensions to bring more dollar demand and bring more outflow in your basket of risk currencies, which your basket of risk currencies includes GBP, Euro, AUD, NZD, CAD, and so forth. If we do not have those reactive events, then rate cut bet euphoria is still too strong. And also, we had weaker US economic data, which also makes US dollar individually less appealing. So we do have more demand in our basket of risk currencies and less demand in the US dollar. Also with GU, I don't think we're going to be getting a extended pullback phase for no reason. But I would love to retest into the key level 263 in this previous wick high, or just break above the key level 269. The next major area of interest is just watching reactions slightly above the key level, and then really just looking to target next key level 275s. Right now, we're seeing that shift of structure on GBP USD and on Euro USD. Where it looks like Euro USD can still be digging into like the 1.092s and so forth. Especially if we're not noticing any of the rate cut greed being faded. Dollar still individually more active in bearish price action, because with dollar individually, we're for sure going to wipe out the move minimum of last CPI, which was here. We just have a little bit more to go, pretty much into the gray zone here. For sure, we're still going to do that, right? We're going to cancel that last hot CPI report out with this cooler CPI report, right? And now we're getting confirms of potentially having reasoning to shift structure here too, with stronger bearish market structure being formed on the intraday timeframes. Give or take a pullback to the previous lows and roughly the retest of broken structure and the retest of bearish structure formation, it looks like dollar can still be chugging lower into the 103s and even breaking below the 104s here and chugging lower from those prices as well. There's no fear regarding higher inflation at the moment. We're still seeing this one report cooling just on forecast. We know rate cut bet greed holds more weight than pushing back rate cut bets. We also had weaker US economic data, from the surprising bad jobless claims last week to the retail sales report this week. to the Fed manufacturing report as well, which was reported at 8:32. And in terms of economic data for the US, nothing crazy important for the rest of the week, but we still have another jobless claims report tomorrow. Now, I don't expect to see another surprising one above 231K. We may see a decline from prior, but if we're still above 225K, still above forecast, it is still showing signs of cooling in the labor market. And we also have expectations of more weaker industrial production and fairly Fed business index data. We do have the potential with data results tomorrow, give or take some price whipsaws, to still be feeding into recessionary scares and rate cut bets, and also just leading to less demand in the dollar due to weaker US data. This could be the catalyst tomorrow where if we have one-sided poor data, for gold to break out into new all-time highs or even dig deeper into like the 2420s there, and dollar to sink lower into the 103.5s, 103.2s. Right? US30 still continuing healthy liquidity flows, rate cut greed active. New intraday highs printed, sitting at the last all-time highs. Looks like it could for sure break out higher. Minor pullbacks where we had this last bit of an accumulation phase and retest of structure, or continuing to hold above key levels, still looking bullish, less demand in the dollar, VIX is flat, healthy volatility and liquidity inflows into risk assets, even with Bitcoin, gold, US stock market, with the rate cut euphoria and outflow out of dollar, is still looking very healthy across the board there. But before we jump into the individual trade ideas for Asian session, London, and potentially even the rest of the week, as we don't really have that much going on through the rest of the week, tomorrow's Thursday, where these aren't that important data reports, but compared to like CPI or NFP or PMI, but it's still going to be nice because we have a collection of data there that can still feed into the rate cut bets. And then for the rest of the week, May 17th closing off there, we're just going to have some inflation figures for Euro to give more ECB policy signals, and then nothing for US Friday, right? So really, tomorrow's looking like the last potential insertion of volatility from data reports if we get one-sided bad data there. Friday will probably just continue the moves. Maybe Friday, end of day, see some profit-taking moves after such aggressive moves through the week and last week, right? But in terms of the next sessions, we do have some important Japan economic data. Japan GDP figures, growth figures, which growth figures, jobs figures, inflation figures, always the focus for central bank policy positioning, rate hike clues for Japan and Bank of Japan in specific here. Overall, not looking too good. all the estimates quarterly for annualized capital expenditure, external demand, everything's forecasted in the negatives. Now, obviously, with the forecasted expectations in the negatives, if it comes out right on forecast, it's not going to hold that much weight. If we're still above forecast, still showing a little bit of optimism, it can bring some short-term Japanese yen strength, which on GJ, which we primarily look at for our yen cross pair, GBPJPY, is just going to lead to a short-term pullback, get faded out, and buyers are going to continue the GJ bullish trend. So regardless of this data result, even if it's good, I just see a short-term pullback on GJ before continuing bulls. If it's bad, I still just see more GJ bulls. Nothing really going on through the London and European trading session besides some Italy inflation figures, but won't have too much of an impact on Euro overall, as we have the following day Euro inflation being reported anyways. And then May 16th, during our North American trading session, we'll start the Zoom at 8 a.m. Eastern, and we'll be looking at some housing starts data, mainly looking at jobless claims, Philly Fed business index, and industrial production. If we want to make things easy for the rest of the week, we just want to see some shitty data. We want to see it all lower than forecast, while jobless claims higher than forecast, because that means it's shitty if it's higher than forecast. Philly Fed Business Index lower, industrial production lower. We can still see more dollar bears, more gold bulls. We may even see, with the data report release and volatility, gold react at the all-time highs, do a pullback, but then buyers come back into the table again. Similar to like on the intraday, what we had take place here at these intraday highs, where we had this reaction, but it wasn't a sell signal for us. What we were looking for is to jump back in the buys. We may see that just in terms of order flow reactions into the 2400s there. You know what I'm saying? Anyway, specific trade ideas. I don't really see gold having an aggressive profit-taking move to retest intraday bullish structure back to the 2350s for no reason. What would make a lot more sense to me is Asian session continuing the rate cut euphoria squeeze, especially as rate cut euphoria, aka weaker US dollar, is what these Asian countries prefer. They would love to continue short selling the dollar with the rest of the market right now and letting their currencies get a little bit of breathing room, right? So through the Asian session, we may just, in my opinion, retest the previous highs, 2377 to roughly 2375. I like where all these candle bodies were closing here. Or just simply break out after having an accumulation up here, simply break out, and we can get entries earlier than the 2393 key level, above 2389s, 2390s. I don't see a reason for the entire CPI move, bad jobless claims impact from the previous week now adding on to it, of weaker recessionary scare data, poor retail sales. I don't see this move being faded out for no reason. But we can see into the new daily candle period, still squeezing through Asian and London into all-time highs here on gold. Still in a bullish bias. Just be mindful of price reactions if we do have this analysis play out and we do go into those all-time high areas. But rate cut euphoria is healthy. Liquidity and risk assets and those inflows are still healthy. Nothing's shaking that yet. Powell can take a continued slow and steady approach. Markets will just digest that as dovish to continue the greed in stock market. All this means less demand in dollar, and asset classes that thrive in a lower rate environment or the potential of a future lower rate environment to be more bullish right now. GBPJPY. Don't mind the subjective trend line. This is just a visualization of structure. Based on prices on the intraday, and just removing the PPL guide points here, GJ is still bullish above 196s, and the next buyer area interest is key level 195s, right? But if we're not even breaking below 196s, no chance of coming here. I still see that if we're holding above 196s, GJ still continuing the slow and steady chug, less demand in dollar, more demand in your basket of risk currencies. Yen is still individually just generally weak, nothing crazy going on there, and continuing to chug into these last highs printed in the deeper 197s. Even if we do see short-term bears, if we break below 196, don't just try to buy every little lower time frame support or bounce. The next buy area I'd be thinking about is 195. GBP USD. We're not really showing any signs of exhaustion. We had some lower time frame price reactions here. If we break below here, we could easily come to retest where we saw some more buy orders accumulating through the North American trading session with the price whipsaws of that CPI data release. If we break below the gray zone, we'd see a rough 30 to 40 pip pullback to retest 263 before continuing the dollar weakness sentiment. Otherwise, holding this area, breaking above the key level, we're just continuing the squeezes through Asian and London session, as we don't really have any reason otherwise. Obviously, still keep your head on a swivel on the newsroom and any reactive headlines, but geopolitical tensions are dead quiet, priced in, premium priced in, no major fear, uncertainty, or doubt to spark dollar demand for its safe haven appeal or lead to outflow out of GBP or euro there. Rate cut euphoria still active on the US side there. So we're still keeping that as is. Euro USD. $1.084 is the buy area. We could just dig a little bit lower than key level, 1.086. And after the daily just makes a lower wick, continuing the squeeze, slowly continuing the chug. Asian and London, 1.089 still buys. USD CAD, potential to dig back into prices 1.355, 1.35. Dollar actively bearish, showing more intraday bearish structure and lower time frame bearish structure. I don't think we're going to come retest intraday bearish structure for no reason there. But retesting these lows in key level, breaking these current lows. Watch reactions here where we had the last hot CPI report move. Might get a reaction at 355, but breaking below there would also be sells as well. US30, be mindful of reactions at all-time highs just for some profit-taking moves, but doesn't look like we're showing any signs of exhaustion just yet. Rate cut euphoria in full force still. Market greed active before elections. Outflow out of dollar. VIX is flat. Very solid bullish price action and bullish market structure. We'll love to see a pullback to 39,650s. Breaks above 39,900s. And into the 40K prices here on US30. Unless we get some black swan event, which we can't predict the timing of that. Oh, sorry, that should be green. Unless we get some new fear, uncertainty, or doubt, which I don't even think long-term that would impact this pricing. Doesn't look like we're going to be having any deeper bearish legs anytime soon. We either need the next set of inflation reports to be very hot, some type of black swan event, or some type of new FUD. And trying to ride those types of predictions that have not happened yet, or you cannot time, is stupid and illogical. Right now, what we do have is healthy liquidity flows in the risk assets, still having the can kick down the road on the inflation fight with rate cut bets still being held very active. Recessionary scare data still keeping rate cut bets active. Bullish price action, bullish market structure. Intermarket correlation confirms VIX is still flat. Dollar seeing those outflows as well. Global equities are starting to pick up the pace, following suit with the US too. All right, everybody. If anybody has any questions, I'm just going to give you guys a couple minutes in the chat here, but hopefully that was an educational, informative, and useful webinar. All right, everybody. Thank you. Thank you for your comments. Appreciate you guys always tuning in. I'm glad we can do this together here. But I don't see any questions or anything, so I'm going to save and upload this. And I'll see you guys in the morning. Possibly even I'll be tuning in to Nalab's Asian session this evening as well in a few hours from now, 3 to 4 hours from now.